Well, good morning. Thank you all for joining me. Now we'll get back to the current charts. What I'd like to do today is start off, I trust you all can hear me, including Mike. Start off with a kind of a review of the process I go through each weekend analyzing the markets. And then after that, throw it open to questions. And because I really like to respond to your questions. And also, we will tentatively plan to do another one next Saturday. And so you can send in your questions for that. So a pretty ugly close. Hopefully, I know some of you don't like Twitter, and it's getting harder to like Twitter these days, but that's a whole nother issue. But, the advanced decline numbers yesterday started off about 2-to-1 positive. Let's see what were the exact numbers. Like I think they're about a 1900 to 1100, and but that deteriorated, throughout the day, and that was a pretty negative sign. I tweeted out. I mean, you can see where. Let's see. This is typically what I do, and those of you who have stock charts know that stock charts updates a couple of their numbers on a regular basis. So, this is sort of, you can see we went from about 1800 versus 900 to 900 versus 2200. You can see what happened here in the Dow and the S&P. We'll get into the futures. So it was that does not bode too great for next week. But let's look what the technicals say. So first of all, we have the SPY. Weekly SPY hit the most widely watched downtrend in years, I'm sure. We've had those in the past 40 years or so, but usually not that many people are watching the charts as they are now. So, this close, was just barely, above the 20-week EMA, which is at 392.66, so 393.27. You can see the AD line is still positive, but not by much. I mean, and so next week, we get a strong week of breadth, it could look pretty, positive, but, coulda, woulda, shoulda, it's looking less likely. At the start of the week, thought there was a good chance we'd get a pullback, but also that it would be short and less heavy selling than what we saw early part of the week. So you can see this is the resistance the S&P 500 AD line needs to get through in order to, turn things bullish. Otherwise, we'll drop back below that moving average. I think we'll probably still hold these lows, but, you could get back into the, 270, 260, 270 range. We'll see it as you take it. The on-balance volume has flipped back to negative on a weekly basis. That's, it's been anemic, clearly, throughout this last rally. So let's look at the Qs. Qs are, we point out the relative performance analysis on the Qs has been really poor. And, it continues to, look like it's going to be, under the most pressure. And you can see the AD line here has flipped. And I think that low was at 13,552. And currently we're at 13,548. So it's slightly below this level here. So that's not a great sign either. And but we'll look at the growth value analysis here in a bit. Sort of OBV also looks pretty sad. And last of all, the most worrisome part probably is the NYSE. It started giving us the most clues, of a correction, not the full sell-off that we got, but in late last year, because it was starting to, deteriorate, new highs, etc. The common stocks were not joining the party. And so this close is here, we'll be watching this 14,992 area, but the AD line has dropped back below its moving average. So the weekly we're 4 or 5 out of 6 were positive as we started the week, and now we have the Russell negative, the NYSE negative, the Q's negative, and both NYSE. So, it's pretty much across the board. Let's look at some of the daily charts of these before we move on too further, because that's really, if you're trading, that's kind of what's important to get a feeling for. And, you can see, we got down here for this bounce, drop below the moving average. So, those who've taken the advanced decline line course, I sort of, once we see this, I don't try not to make too many assumptions that this is just a pullback, within the ongoing uptrend, because anything can happen. You can see the formation here on a daily basis also looks, pretty negative, and now, has gone, this low here. We've dropped below it, so we're in a short-term downtrend here. Daily OBV, of course, is pretty weak. So then you kind of look at, what kind of, retracement, you might see. And, you can see numbers are probably too small, but the 38, 386.43, 379.12, 171.80. So that's kind of the line in the sand. You break below that, and you have to assume that we're going to, drop to new lows at that point. So, that's kind of, and let's look at the NASDAQ. See it on a daily basis. It's been even weaker. You can see that, it did form this little divergence at the doji high. So we had doji, we formed a doji on Wednesday. So we got a short-term doji buy signal here, but suspect, let's say. And particularly when the AD line, is clearly, you start to make a lower low here, below that low, lower high, so, that's a clear downtrend here. It would really take a fair amount of work to turn it around. So we were looking to buy the QID on a pullback. We didn't get the pullback, and I was probably being too cautious. I probably should have got a little higher, but we'll see Monday. I still think we could get, time-wise is important in this sort of, so if you look at the Qs, you say, well, okay, enough time has taken place. You look at the S&P, you can say, well, we should still see one of those sharp flashes to the upside. Maybe it'll be the FOMC meeting. Maybe it'll be a better than expected CPI report on Tuesday. But we'll be following. But the evidence here suggests that, a rally will likely fail at this point. So let's look at some other charts. Let's see. Okay, so this is the scan I often run in the Viper ETF and the hot stocks. Interesting that we're trying to hold the 100-day moving average, 3091.56. Of course, the low we had, when we formed a weekly doji 3 weeks ago, this low right here was at 390.14. So, you break that, and you're probably going to break this low at 385. The S1 here is at 381.75, and that's about where the 50-day is. So, oddly enough, you have the 20-day above the 50 and above the 200, but the 20-day is starting to roll over. If you look down on this, you can see that the S&P, in terms of long positions, it's the one to watch because it has been the strongest. But, on a short-term basis, it's got some work to do. Support here and then support down, about this level here. So stocks only, made a new high. That's about the best thing you could say, heading into the Fed comments, but back to negative, also in a short-term downtrend. And the NYSE all, also looks pretty negative, even though the strength in the bond market, has been supported for a certain segment of those bond funds, et cetera, that are in the NYSE, certainly has not, been enough, to change the picture. So, this is, we're breaking this uptrend here. So, we're moving into the corrective mode. And then it's a matter of, what level we hold. But, I would think, the most least bearish scenario, if you will, is, 383 to 381. Let's see some of the other. So here's the, this is a really short term. You've probably seen this before. It's advances minus declines on the NYSE, a 5-period moving average. So, if you're a short-term trader and you're looking about, taking a position right here, it's, you're really, this reading would suggest you're buying puts, not calls. Conversely, if you're down here minus 1,000, that should be your, structure. This one, we had a little bounce, but we tailed off. If we'd seen a Thursday's rally was not that impressive, I think I commented on, and I would like to see it get up to that plus 200 to 400 level going into Friday. Didn't happen. So, now it looks like, get down to the minus 1,000, minus 1,300. You can see it got down to whatever this was, minus 1,800. But, it was a couple days below, before the lows. Similar here. It was minus 1,800 too. And that happened, 1, 2, 3, 4 days before the lows. So when you see this, if you're looking at something like this and you're short, then it's sort of like, it's the sign that you say, okay, well, besides the fact you were, testing the Stark bands down here, kind of like that, well, okay, I don't want to get greedy. I'm going to start, peeling off my short position. Not necessarily enough by itself to say buy, but, it certainly, is something that suggests that, the market's sold out. So let's look at, put call ratios haven't been doing much, but they started picking up on Friday. They have really low levels. The CBOE index, first of all, it turned up to 1.32. So essentially 30% more action volume in puts than calls, at 1.15 here. So it hasn't really, seen a lot of extreme, levels. Oftentimes, if you look back, let's look back 4 years, we'll see some level times when, COVID, time, March of, it was over 2, it was like 2.3, I guess, so, that's typically a level where, it's an extreme. So no sort of extreme readings, in the put call data. The sentiment stuff here is a weekly chart that I often feature. So, AAI guys are still pretty skeptical, down to 24%. Looks like that's probably, maybe this is, I think, indicator's been in business since 87. So maybe, people are starting to, the AAII members are starting to look at more charts or something. It may not be as good as a contrary indicator as it has been for decades. So we'll see about that. But anyway, certainly, this era right here, that was a low that went back, I think, to the recession of 1990, Bush 1 recession here. So, if a change in sentiment probably move above 35, that would be on a chart basis, would be a sign that, okay, people are actually enthusiastically bullish if it stayed above there for 2 consecutive weeks. Also disappointing, the NAAIM. I want to follow this one. If you don't have stock charts, here's the symbol. It's asterisk or exclamation point, NAAIM. Or if you just search NAAIM, they have a website. And, it shows you how much they're on the long side. I thought this time around we might get above this peak, get up into this 80 area. You can see that, typically, it had a nice divergence here. It peaked in November and then, much lower highs, when the S&P was making its high. AD line, as I said here, weekly. We've had more flips above and below its moving average in the last year than we've had probably in the last 8 years. Normally it gets above it and stays it. So it's been a pretty choppy ride here. Let's see what else. High-low analysis. We saw that in the video. It still stays surprisingly positive. So it hasn't surged above this peak here, but what you look for now, if from the new lows is, say, if we get above 540 new lows in the NASDAQ composite, that'd be a negative sign. That would break this sort of downtrend here. They've still been pretty low. You can see what happened, at the June low. We had a pretty classic sort of formation here where we had the number of stocks making new lows peaked here as the index was making a new low. There were fewer stocks making new lows, so that was a bullish. It's a contrary indicator. That rally, the new highs didn't really, just got right back up here. The new highs have been doing better. So, you're looking long term. That's probably a sign of, that the next decline is going to, strengthen the bottom formations. But we'll have to look at the AD lines to be sure. And let's see. Value cat. So let's, talking about this chart since this peak, I think, and go back in Forbes in November of 2021. So, this shows you that, ever since, from basically 2001 through 2007 was a value rally. Okay. So the value stocks, were leading. The bear market, 2007, 2008, that's where growth took over. And obviously they've been doing a gang up just, but in November, you can see that the MACD and the MACD histogram form these really classic divergences at the highs. So that was a suggestion once we dropped below this level here, which we did early in the year, that value was going to take over. That seems to be the likely scenario for the next, these cycles typically do not change. If you look at them, obviously from, October of 2007 through November of 2021, quite a while. We've dropped back into this channel. So I think we'll probably see a pretty good rally in growth in the next, 4 to 6 months. MACDs are still negative, showing no signs yet of a bottom here. You could make a case that, well, there's a slight divergence here, but it's probably looking for more than's really here. If you look at the weekly basis, you see a similar sort of scenario. Had that perfect rally, August rally of growth, right back up into resistance, bam, down again. So, the weekly stuff, looks like, another wave of selling is probably going to be concentrated in growth again. Not like it hasn't been bad enough already. MACDs here, it does give you some pretty nice divergences, which is, part of the reason I designed it a few decades ago. But I don't use it as much on markets that have volume, but on certain things like this ratio, interest rates has become very, very helpful and very illuminating. So let's look back at Trade Navigator. Speaking of rates, let's look first at the 10-year. So when that video from the 4th of, November was right about in here, we were looking for that top. So we did break that support as we thought we probably would, and in line with the MACDs. So, it's done a really good job, in the last 6 months. It doesn't always quite this close a correlation, but, you can see the MACD, turn negative. So that was, the rally in stocks. Then rates turned back positive and, formed this complex top that just sort of killed everybody in the bond market because, they probably, bonds were getting hit so hard, they probably sold out at the at the wrong time, and now they're in a quandary. MACDs, we could be in somewhere in here. So I mean, if we see another uptick in rate, and you can see the daily, MACD HIS is showing a divergence here. The fact that the 20-day moving average is kind of, still declining, that suggests maybe it's going to take a week or two at least. Usually when it's at this sort of slope, you can see what happened here. It's sort of like right about in here, flatten out. You like to see it flatten out. So, but that's something to see if this divergence holds. We could get a sharp rally in yields that push the MACD histogram back above zero, and then we get another pullback, and it'll keep that divergent support there. So that's kind of what I'm looking at in the week ahead. On the bottom of the chart is an interest indicator I don't think I've shown before, but it's something I comment on. So this is the gap between, in this case, the 10-year T-note yield and its 20-period moving average. So we talk a lot about the fact that, well, okay, if it's really well above its 20-period moving average, that's a high-risk area to buy, and a low-risk area to sell. And on our table, every issue that it's sort of like you get during the rally, you get the SPY or the Qs like 5 or 6% above the 20-day. It's not a time to be doing new buying, and also in individual stocks. It also has some pretty nice divergence capabilities. So you can see it also formed a clear divergence here at the highs. So indicating that the yield, that the trend was waning up here, and also gave a similar sort of bullish divergence here at the lows. So it's still negative, no real divergence, lower lows here, but something to look at. The two-year yields haven't broken down. Technicals are still negative, so we broke this support I've been watching, but not a lot of follow through in the downside. So this level right here, I think, is just above 4% right here. So you'd really have to break that to complete a more significant top, and more likely, that the yields are going to head back up here, I think, as we head into the year end. And MACD is still negative, but also same sort of bottoming formations, and the 10 and 30. This indicator, you can run it in stock charts, and but I also follow it on the like things like the Qs. So you can see that this, the doji rally here, lower highs in the gap between. Remember, this is the point difference between, the QQQ and its 20-day moving average. That's why it's negative now. So you look for it to get down in here territory. That's when it gets oversold, and it also had sort of a bullish divergence. You have to go in stock charts. You have to go into their new platform to do it, but it's not too hard to do it. And if you're interested, maybe I'll include a chart in one of the publications, and I'll send you a link so you can incorporate it in here. But you can see the MACDs, on the Qs are also not looking too great, as we head into next week. Well, I hope you've enjoyed this segment from a recent Zoom session. Be sure you're on the Viper Report free email list, and you'll get updates and invitations to future Zoom sessions. If you want specific market advice on either ETFs or stocks, if you go to the Viper Report, you can sign up, just $34.95 a month. We give you specific entry and exit advice. And for stocks, we're a little more active probably, and also interim updates frequently, which, given the market volatility with the Fed and the CPI report, we've already had often have 3 or 4 updates a week. We also have a special offer for traders and investors. If you want to learn more about technical analysis as we start 2023. I do have open slots for training in January. This will get your feet wet, so to speak. $199. We'll spend 90 minutes, you and myself, one-on-one, and I'll assess where your level of expertise is, and we'll go from there. And they also includes a follow-up, a pretty unique opportunity that I don't think anyone else offers. If you want more information on this, you can also just email tom@viperreport.com and say special training, and we'll get back to you with information.